Welcome to our financial overview. Today, we're exploring who Jerome Powell is and how Fed rate cuts influence the market. Let's dive in. Jerome Powell is the chairman of the Federal Reserve, the central banking system of the United States. Appointed in February 2018, Powell has played a crucial role in shaping U.S. monetary policy. Here's a snapshot of Powell's background. Early career. Powell is a lawyer and investment banker, with experience in both public service and private finance. Federal Reserve experience. Before becoming chairman, Powell served as a Federal Reserve governor. His experience gives him a broad perspective on economic policy. Leadership style. Powell is known for his data-driven approach. He relies on economic indicators and trends to guide monetary policy decisions. Fed rate cuts involve lowering the federal funds rate, which is the interest rate at which banks lend to each other overnight. This rate influences the cost of borrowing across the economy. Here's how rate cuts affect the economy. Lower borrowing costs. When the Fed cuts rates, loans become cheaper for businesses and consumers. This encourages spending and investment. Economic stimulus. Lower rates can stimulate economic growth by boosting consumer and business spending. Market reactions. Financial markets often react positively to rate cuts, as they can lead to higher corporate profits and consumer spending. Fed rate cuts have several notable effects on the market. First, let's talk about the stock market. Generally, lower interest rates can lead to higher stock prices. As borrowing becomes cheaper and economic activity increases, businesses tend to perform better, boosting investor confidence. Next, the bond market. Lower rates typically result in lower yields on bonds. Investors might shift their money from bonds to stocks in search of better returns. And then there's consumer behavior. With lower rates, consumers might be more inclined to take out loans for big-ticket items like homes and cars, further stimulating economic activity. It's important to note that while rate cuts can boost the economy, they also come with potential downsides. For instance, inflation. Prolonged low rates can lead to higher inflation as increased demand pushes up prices. Another potential downside is asset bubbles. Cheaper borrowing can sometimes lead to excessive risk-taking and asset bubbles. In summary, Jerome Powell's leadership at the Federal Reserve is crucial in navigating the economic landscape. Fed rate cuts can stimulate growth and impact various financial markets, but they also require careful management to balance benefits and risks. Thanks for tuning in. Stay informed about financial trends and how they affect the market.